Welcome to the Real Estate Espresso Podcast, your morning shot of what's new in the world of real estate investing. I'm your host, Victor Menashe. This is the weekend edition where we interview notable people from the world of real estate investing. Today is no exception. We have a great guest all the way from Austin, Texas. Welcome to the show, Scott Carson.
Victor, honored to be here. Happy New Year to you, buddy. I hope everything's rocking and rolling for you.
Doing great. Thank you, and Happy New Year to you as well. You've been on the show before. Love to get an update because the market is continually shifting and a lot's changed since we spoke last. You're based in Austin. You specialize in closing distressed notes of all different types. But maybe for the folks who haven't met you yet, perhaps give a tiny bit of your backstory and how you got to this point in your journey.
Yeah, I've been a real estate investor for coming on. This is my 25th year as a real estate investor. Done a lot of other things, fix and flip, subject to some development, landlord, stuff like that. But for the last 18, I've focused primarily on just buying distressed mortgage debt on residential and commercial property all across the United States. We only buy first liens. Our big goal when we buy the mortgage debt is not to own the actual real estate, it's actually to become the bank and control the cash flow. And we buy non-performing stuff most of the time at a big discount so that we can then work it out with the homeowners, the operators, and get them back on track, get the cash flow for profits, and then for a period of time, 24 to 36 months, look to sell that now reperforming debt back to Wall Street and things like that. Of course, if the borrowers don't work with us, don't want to work with it, can't do with us, we'll work to take the asset back and then rehab it. And as we like to say, we like to turn problem properties into profitable solutions.
Absolutely. And if a property goes into distress and the lender ends up taking a haircut, the person that buys that note for whatever, 20, 30 cents on the dollar, if they resell that as a performing asset on 40 to 50 cents of the original value, still is a massive discount to the original value, but it's a sizable profit compared to what you bought it for.
It's exactly right. When I buy that debt at a discount, it doesn't reduce what the borrower actually owes.
Exactly.
And, so that's the great. I wish we were buying them at 20 cents to the dollar. That would be back like 2008, 9, and 10.
Yeah.
But we're still seeing sizable discounts on residential commercial notes across the country. And that's our whole goal. Buy it at a discount. We've got the flexibility to work it out, some sort of payment plan, modification, forbearance agreement with that borrower. And then after 12 months of on-time payments, that borrower's either is reperforming again back on time and increases the value back up to where the loan is at or where the value of the property is at.
At whatever you've renegotiated that payment to be, might be 80 cents on the dollar, but if you bought it at 50, now it's worth 80 and you're in great shape.
Exactly. Gives us all the flexibility and control the asset. We're only buying first liens too, so we're really in the driver's seat. The only thing that can wipe us out would be God or taxes. And we might make sure we've got insurance on it in case of an act of God, make sure the taxes are paid.
Exactly. Now, what have you seen in the market? We keep hearing an awful lot. There's a number of communities where today, if you read the analyst reports, there's properties underwater now it's been close to a decade since we've been able to say that, but it's now reemerging. I'm thinking of communities like Riverside, California, places like that, where there's showing signs of weakness. Before we started recording here, we've talked about some communities in Florida as well. Where are those? Is it just a few hotspots? Is it a falling tide?
Yeah, I don't think we have people. It all depends on who's more dramatic in the news. I think some people will say, "Oh, we're experiencing a crash." I think it's just a correction. I live in Austin, Texas, and Austin has done really well. A lot of population growth, a lot of building, property values really escalated pretty high. We're seeing a pullback on values, and I think that's what we're seeing really across the country. It's really true. People come to their senses. Obviously, markets have cooled as interest rates has gone up and not come back down. Days on markets are, extending hold times for people thinking about the sale. A lot of people didn't want to refinance or sell their house because they were in such a great interest rate. But what we've started to see, especially on the distress side, it was literally like people waited till the 2nd of January or the 5th of January to start sending out their distress list because we deal with a lot of banks. And this is really technically the first business week, the first 5 days of 2026 when it comes to business. We've seen a huge amount of lists of notes coming out. I mean, literally on Tuesday, I got a list of 4,200 non-performing residential first liens all across the United States, including 252 homes in California, all across the Bear Republic. Same thing in Florida and in Texas, where we've got the fastest foreclosure timeframes in the country. A tenth of that list was in Texas. And I don't usually see a lot of stuff in Texas for the most part. So that tells me that these banks have finally said, okay, it's new year. We've got to get the stuff off our books. We're starting to see an increase in distressed commercial loans actually coming across. And we've seen a lot of distressed commercial loans for a while, but price drops in some of that paper. It's kind of signaled that the banks, the lenders out there, like, okay, we need to move this off our books this year. We can no longer continue to kick the can down the road. We can't keep giving, modifications or forbearance agreements when people aren't making any payments on their stuff.
Absolutely. So extend and pretend has come to an end.
I think so. In some cases, all depending on where the lender is. But what you see is so many people bought property, a lot, especially commercial property, bought multifamily's been in a state of disarray for a while now. But folks that bought in 21 and 22, and those 3-year term loans have expired in the last year or so. Banks were trying, okay, let's try to see if we can get this bar back on track or try to see if the market changes. They're seeing that the market's not shifting. So now they've got to do something because here, if you look at, especially here in the United States, the larger banks, we have something called the Texas ratio, which shows how bad their portfolio is. Is the property or the paper worth what the asset is? And a lot of banks across the country, their Texas ratios have skyrocketed, showing that, hey, the paper they hold isn't worth the paper it's written on, or the assets they hold isn't worth the paper they're written on. And so they're finally having to make those hard decisions like, okay, we've had to hold stuff back in reserves and stuff. Let's get this off our books so we can maybe free up some lending opportunities and make the money.
Absolutely. So if someone wants to get into this space, where do you look? You just put out a shingle on the side of the freeway and...
No, you wish. I mean, that's a lot of it's like a bandit sign. Hey, we buy foreclosed homes, stuff like that. No, I mean, buying notes is a little bit different. I mean, I always say reach out to me at weclosenotes.com. We've been teaching investors how to buy distressed notes. You're not going to buy all across the country. I always say, folks, focus on 3 to 5 states here in the United States. We actually have quite a few Canadian investors that are investing here in the United States as well, because you don't want to go buy a note in New York or New Jersey, which can take you 2 to 3 years to foreclose. You know what I mean? And not all notes are created equal as well. So we've got the podcast, number 1 podcast on it, called the Note Closure Show, and then our website, We Close Notes. We teach classes all the time on it. We're a very kind of no nonsense. We'll show you the note, straight to the point, no smoke blowing, how to go buy your first note, whether you're buying a $50,000 note in Miami, Ohio, or a $500,000 note in Miami, Florida.
Now, in a lot of these cases, are folks that are getting into this business, are they syndicating the closing of these acquisitions?
Well, they usually will start off using their own fund or investor funds, leveraging self-directed IRA investors in the United States. But as they start buying more and more, they'll start creating funds and creating syndications to take down bigger assets and bigger portfolios, or larger commercial deals.
What distinguishes note purchasing from purchasing properties from a due diligence standpoint?
So with a property, you're going to do what? You're going to pull title and you're going to pull a comp and then look at conditions of the property. And that makes sense. Great when you're buying. But with buying notes, we have to not only do that to determine value, condition, we also have to look at the collateral file, the loan file, the documents, making sure that if we have that everything was written correctly and that we have the right to foreclose if the borrower stops paying. And then we're also trying to evaluate the borrower, the credit worthiness of the borrower. So whereas most people go out and they get a loan and a loan qualification package, I often say it's a dequalification package we receive in a lot of cases because things can change. People lose their jobs, people get divorced, markets can change, values can drop. So we're evaluating the borrower, the property, and then the actual paper aspect of it. And then, of course, our profitability. Is this going to be a great deal? What multiple strategies do we have on an asset, that we're going to take down? Are we trying for the cash flow? Is that going to work? Or are we going to have to work to foreclose and take the asset back?
When you acquire an asset, are you always looking at, we have to have a minimum of 2 exit strategies on this particular property? Or, how do you make that decision?
Great question. If it's occupied, yes, we want to definitely have multiple strategies of either, hey, is it going to make sense that the borrower can come to the table and reinstate the loan? Or if we work to modify it, do a trial payment plan, what kind of options do we have? And then it's going to make sense as far as the profitability to buy that note. If we have to foreclose and it sells at the auction, we can make money there. Or if we do take the asset back, is it going to be profitable? We have to fix it up. Now, if it's vacant, you're not going to get a borrower to come to the table and start paying on time. And we've seen an influx of non-performing reverse mortgages hitting the market here, where the borrowers are deceased. And those places, not to get the borrower back on track, most of the time the families are unable to fix the property up or pay off the loan. And so our play with that is strictly buying it at a discount, where if we foreclose, because that's the main strategy with that, does it make sense is it going to make profit at the foreclosure? And that's very state by state. I'll give you an example. We bought one here recently in Texas, like last month. And Texas has a fast foreclosure market, but it's also valued higher. So we paid 89 cents on the dollar of the balance of the note, which is a little higher than we normally do, but that's equated to 65% of the total value of the house. So there's a lot of equity. And so we're kind of rolling the dice here. Like if it sells at the foreclosure auction, we'll only make about 10% in 90 days, but that's still a pretty good annualized ROI. Our goal is that hopefully it doesn't sell at the auction and we take it back as an REO, and then we can turn around and list it on the MLS and sell it traditionally with a light, very light upgrade to the property, because it's in really good condition.
I love it. Well, Scott, if folks want to connect, if they want to learn more, what's the best way?
Easy. Reach out to me at our website, weclosenotes.com, or you can always book a phone call at talkwithscottcarson.com. That'll take you directly to my calendar and book a phone call. I'm always glad to chew the fat and talk about real estate.
Love it. Well, Scott, great to connect as always. And for the listeners at home, definitely connect with Scott Carson at weclosenotes.com or directly with talkwithscottcarson.com. Links will be in the show notes. And in the meantime, have an awesome rest of your weekend. Go make some great things happen. We'll talk to you again tomorrow.